Special order decisions. In a special order scenario, a company is requested to produce a one-time, unique order. Acceptance or rejection of the order. Evaluating whether the order should be accepted or rejected based on the provided selling price and relevant details. Minimum acceptable price. Determining the lowest price the company should set to accept the order. Marginal direct production costs. These are the variable costs incurred specifically to fulfill the special order. Opportunity costs. These arise if the company is operating at full capacity, as accepting the special order may require reducing or displacing regular production. Careful assessment of these factors enables the company to make an informed and strategic decision. Direct or avoidable costs of production. The minimum price for a special order should cover all costs directly related to producing it. These are costs that can be avoided if the order is not accepted, such as variable costs like direct materials, direct labor, and variable overheads. If there are other fixed or variable costs specifically tied to the special order, they should also be included, as long as they wouldn't occur without the order. However, fixed manufacturing costs and non-manufacturing costs that won't change whether the order is accepted or not are not relevant. Variable overhead is usually considered to be an avoidable cost for special orders, as well as for make or buy decisions. Level of operating capacity. The minimum price for a special order also depends on the company's current capacity. If the company is operating at full capacity, producing the special order means giving up another order that could have been produced and sold. In this case, the price must cover not only the direct costs of the special order, but also the opportunity cost of the lost contribution from the order that cannot be produced. If there are fixed costs directly tied to an activity that can be avoided if the activity isn't done, these costs must also be considered in the decision. Contribution refers to the revenue minus variable costs and avoidable fixed costs. It represents how much the activity adds to operating income, making it a broader term than contribution margin. Operating at full capacity. If the company is operating at full capacity, it must consider the opportunity cost when pricing a special order. Producing the special order means the company cannot produce and sell other items, losing their contribution. To avoid a decrease in operating income, the price of the special order must cover both the direct costs of production and the lost contribution from the items not produced. If the price does not cover these costs, the special order should not be accepted. Effect on operating income of accepting or rejecting a special order. If the company has enough idle capacity to produce the special order without affecting other production, any price above the variable and direct costs is acceptable, as it will increase operating income. The increase in income is the contribution per unit multiplied by the number of units of the special order. If the company has no idle capacity, the price must cover both the variable and direct costs. as well as the lost contribution from the products that cannot be produced because of the special order. The increase in income is the contribution from the special order minus the contribution lost from the products that couldn't be made. Total contribution from special order produced. Contribution per unit multiplied by number of units minus opportunity cost. Total contribution from units not produced. Contribution per unit multiplied by number of units equals addition to operating income from special order. Effect of changes in capacity on production decisions. In the long term, production capacity can be adjusted, but in the short term, it is fixed. If more units are needed than can be produced internally, the company may need to find an external supplier. If fewer units are needed, the company will have unused capacity. If production continues to decrease, the company may need to reduce its capacity. Changes in production capacity can affect decisions. For example, increasing capacity may reduce opportunity costs of accepting a special order because there's no need to reject regular orders to make room for the special order. Decreasing capacity may introduce opportunity costs where there were none before. Changes in capacity may also impact decisions about whether to outsource production or keep it in-house.